All right, how are you guys in the Collaborate? Are you guys there?
Yeah, I'm here.
Yes, I'm here. I'm
Okay,
here.
good, good. Yeah,
Hello.
I hear you loud and clear. Matthews, are you there too? Matthews?
Yeah, I'm here.
Okay, good. Um, so let's see. And so we're moving on. No, what is this? I didn't open that. This one. This one is okay. This one is. So we're moving. Oops. So please don't forget to sign into the discussion board, right, for today. May 4th, right? Okay, I see. Uh, Now, Alexander, I don't think Alexander is even online. This is a problem. I don't even see Alexander there. Oops, I keep forgetting that So we're moving on to the new topic today. So we're moving on to stock valuation, okay? Finally. And then, of course, after stock valuation, we'll need to go back to the risk and return, part 2. So let me open, which one should I use? I think I will use this one. Okay. Can I draw on it? Okay. And let me make sure what there's this stock valuation. So I'm gonna, all right. Oh, I forgot to bring. So so let's think about what stock is. Of course, stock is the ownership of a company, right? So it's equity capital, equity, as opposed to the debt capital, right? A company from the topic 2, right? Financial statements, you learned that the balance sheet is all about capital structure, right? And the capital structure means, how much of the total assets came from debt and how much of it came from equity, right? That's basically capital structure, right? So debt capital is mostly coming from sale of bonds. By selling bonds, you are raising debt capital, right? Of course, some of it comes directly from the loan, directly from the lender in the form of loan, but most of the corporations, their debt capital is from sale of bonds, right? That's why we studied bonds. That's why I studied, bond valuation all this time. And then equity It's through sale of stocks, but not all stocks fall into three categories. Two categories, I'm sorry. Two categories. Common stock and preferred stock. Okay, but the preferred stock is, you think preferred, just by the name, it looks like preferred stock is a better thing. No, preferred stock is not better. Preferred stock, preferred stock doesn't come with voting rights. So the preferred stock is not true ownership. Okay, so common stock is the true stock because it comes with the voting rights. So it represents the ownership. Okay, I forgot to bring my pen, stylus. So let me run quickly to my office. Right. Okay. All right. So the common stocks can be private. A company can be. It's actually. Company can be privately owned, right, by private investors, closely owned by an individual investor or a small group of investors, or publicly owned by a broad group of investors. Think about it. The ownership of a company. A company can be privately owned. In other words, that means stock is not sold to the public, right? Stock is only held by a small group of investors. That's private, right? And then, so it can be privately owned or closely owned or publicly. If the ownership is publicly owned, if the company is publicly owned, what does that mean? They have to sell stocks in the stock market, right? Only when they sell stocks in the stock market, then the company can be publicly owned, right? All the companies start out as a privately held company, right? And then they go through IPO, initial public offering, and then they sell their stocks in the stock exchange, right? So then they are publicly held, and so most of the big corporations are publicly held, right? And by selling their stocks to the public, then they can tap into a larger pool of financial resources. Isn't that right? by selling stocks to the market, they can raise more capital, right? And of course, ownership doesn't mean, I mean, technically, even if I have one share of Tesla, I'm Tesla's owner, isn't that right? But that's just technically you are. I mean, how many shares are there outstanding? Tesla's total number of shares may be like 10 million shares. I don't know, but if you have only one share, you're just 0.000. I mean, how many zeros? 6 zeros. That's 1 million, right? If you have one share, 7 zeros. Your ownership is only 1/10 million, right? So you're only a partial shareholder and minority shareholder, and you are not even. You cannot definitely compare to majority shareholder like Elon Musk or institutional investors that holds like 11%, 12%, 15% of Tesla, right? So, by the way, Tesla, Elon Musk sold, I believe, I don't know what percentage it might be, but he sold a lot of his holdings in almost 8.8 billion. He sold a lot of his Tesla stocks to do what? Anybody heard of anything about what he did? Twitter, yeah, he bought Twitter, right? In other words, to buy Twitter, he had to, sell his shares and use that money to buy Twitter. And then they can pay dividends. And I told you, dividend is not an obligation. Dividend is an optional thing. Most companies may skip dividends, but when they pay dividends, they continue to pay dividends. But once they stop paying dividends, they stop paying dividends for a long time. And from Apple's historical record, you have seen already that there was a time in 1990 something, since between 1995 until 2007, they didn't pay dividends, right? And why? Because dividend is part of the profit. Remember from topic 2. Dividend, you have EAT. EAT is the profit, right? Net profit, EAT, earnings after taxes. And at the discretion of the management, they can pay out dividends. So obviously, dividend has one clear signal. The signal is that they have profit, right? Obviously, without profit, they cannot pay out dividends, right? So paying out dividends is a clear signal that they are doing well, okay? But of course, theoretically, dividend is some fraction of the net profit, right? It's some, let's say it's called dividend payout ratio. So the dividend payout rate, if the dividend payout ratio is 10%, that means 10% of the EAT is being paid out as dividend, right? But if you actually look at dividends, I don't want to go back to that, but when you downloaded Apple's data, you saw that Apple has been paying dividends since like 2007 or 10, and they every year, every quarter, the dividend is pretty much the same. It's only about 20 cents. It was only about 20 cents every quarter. So then 4 quarters, it's not even $1, right? Over 4 quarters, it's If you pay 25 cents, then it's going to be $1 annually, right? But annually, Apple has been paying only about that, $1 per share. So if Apple's profit has been growing, right? If Apple's profit has been growing, shouldn't the dividend have grown too, proportionately, right? If they are paying out only 10%, even if they are paying out only 10%, because it's 10% of the net profit, right? If Apple's net profit has been growing, that 10% must have grown as well, right? But regardless of Apple's actual profit level, they have paid consistently only like 22 cents, 23 cents per quarter, so that they will add up to only about $1 at the end of a year. So what does this tell you? Well, actually, dividend doesn't have to exactly go in proportion, right? Dividend doesn't have to be commensurate with the profit. It's just arbitrary number. They can just pay out any arbitrary number, right? But theoretically, dividend is, because it's tied to profit, clearly, if you don't have any profit, you can't pay dividends, okay? Interesting thing is, dividend is paid in cash, but sometimes in stocks, sometimes in merchandise, sometimes. Now, you might think stock dividends, that might sound like a great idea. If they pay dividends in stock, I'm getting more stocks. No, this is not a good idea. Paying dividend in stock is not a good idea. It's a bad idea. From the shareholder's perspective, right? From the company's perspective, it may, but from the shareholder's perspective, it's not. Why? Think about it. Shares are basically bringing in cash when they are sold. Isn't that right? When they sell stocks, when they sell shares, the capital comes in, right? And they don't sell stocks frequently. Companies don't sell stocks frequently. They sell only when they need more equity capital. But think about it. So let's say at IPO, and when they went public for the first time, they sold 1 million shares. Okay, they sold 1 million shares, and each share was $100. Let's say 10 million shares, and each share is $100. Then what's the total amount of capital raised? They sold 10 million shares, and each share was sold for $100. So what is the total amount of equity they raised? 1,000 billion? 1,000 million. Okay, 1,000 million, yes, but 1,000 million is called 1 billion. Yeah, a billion. So the equity, that's right, 1,000 million. So the total amount of equity is, now think about it. So from the stockholders' pocket, right, $1 billion went into this company. So that's called paid in capital. Paid in capital. Okay. Paid in capital, right? And if the stock price goes up to 110 in the market, the total equity value goes up to exactly to 1.1 billion, right? And every shareholder is happy because share value gained 10%, right? Now, So, but let's say with $1 billion in equity, at least unless the price falls, the equity value will still remain at 1 billion, and there are still 10 million shares outstanding. But suddenly, let's say the share price hasn't changed. It's still $100 per share. So the total equity value is 1 billion. But let's say the company paid, suddenly there is 10% more shares. 10% more shares. In other words, there are now 11 million shares. 11 million shares. Why? Because the company paid dividend in stock, right? So what does that mean? Company simply printed 1 million shares and just distributed to the shareholders as dividend. Now, what's going to happen to the stock price then? Yeah, it will have to drop because the total equity value hasn't changed because it's still $1 billion. It's still $1 billion, right? And then they paid out, the company paid out additional 1 million as dividend, right? They distributed 1 million shares to the shareholders. Suddenly, with $1 billion in total equity, suddenly there are 11 million shares. Now you divide 1 billion by 11 million, price will have to drop, right? So from the shareholders' perspective, this is not a good move. This is not a good decision. This is clearly a bad decision. Well, of course, from the shareholders' perspective, their total holding, their total value of their shares would still remain the same. I mean, if I had 10 shares previously, it would be $1,000, right? Now I have 11 shares, and it's still $1,000. Total value of my holdings didn't change, but per share value has dropped. Per share value has dropped. So there is nothing new added here, right? If I receive dividend in cash, it comes from the profit. It comes from the profit, right? But again, you might. This will also be the same argument, whether they pay dividends in cash or not. There's a dividend irrelevance theory. Dividend irrelevance theory means, when whether they pay dividend or not, it doesn't change anything. The stock value, if they pay dividend, the stock value will fall. So it's like this: the company made, let's say, $1 million profit. Company made, let's say, $100 million profit. Let's say the company made $100 million profit. Okay. Remember, equity at time zero was. Let me write it down here. What is this? I'm gonna have to open a new one. How do I open a new one? Okay, let me write it. This is something we did in topic 2. Remember, equity at time zero. Why is it like this? 1 billion, right? And then EAT at time 1 is 100 million. then we know equity at time 1 is 1.1 billion. You remember this? You remember this? Because in topic 2 we talked about, we discussed this already. EAT is, in terms of nature of capital, it's equity because it's not, this is paid in capital, paid in equity, right? And this is internally generated equity, equity generated by operating activity. Right? Remember that? So by the end of year 1, right? Okay. By the end of year 1, oops, we will have $1.1 billion as equity, right? And how many shares are outstanding? Did I say 10 million shares, right? So number of shares outstanding, 10 million. And think about it. Our price per share, right? Or book value per share at time 1 will have to be what? Previously, you remember this? This is what we did in, topic 2. Now, anyone can answer this? The guys in the Collaborate, can you answer this? What was the book value per share at time 1? I mean time 0. What was the book value per share at time 0? You already answered this. The total equity was book value per share $1 billion, and the number of shares was 10 million. So book value per share at time 0 was $100. Isn't that right? Now, at time 1, what should be the book value per share at time 1? Yeah, yes, $110, yes. So think about it. $110. So if you sell the stock now, you'll get $110. But let's say they paid out, suppose, of this 100 million, let's say they paid out all of this. They paid out all of this as dividend. Okay? Suppose they paid out all of the EAT profit as dividend. Normally they don't do that. They pay out very small fraction of EAT, net profit as dividend. But let's say they paid out the whole profit as dividend. Okay? Then what should be the after paying out dividend? What should be equity at time 1? Equity at time 1 is called retained earnings, because right after paying out dividend, that equity at time one is called retained earnings. Right? Makes sense because you paid out dividend, and after dividend, whatever is retained, that's called retained earnings. So what will be the retained earnings? Once they pay out dividend, what should be the retained earnings? Anyone? I guess at least two guys earned 5 points a while ago. Daniela and Cedric and Dilly. Okay, you guys got 0.5. But anybody in the collaborate? Anybody in the collaborate?
I'm here.
What is the, yeah, so, okay, what is the retained earnings at time one? After paying out dividends, what is the retained earnings? Daniela? 1 billion, yeah. Because you paid out all of this earnings as dividend, right? You'll get what's left, the retained earnings, will just be 1 billion again. So think about it. When they pay out 100 million as dividend per share, how many shares are there? 10 million shares, right? Okay, don't you remember? Okay. So because there are 10 million shares outstanding, and they paid out $100 million as dividends. So you divide it by 10 million shares. Then dividend per share is how much? Dividend per share is $10, yes. Dividend per share is just $10. So think about it. If you have one share of this company, you receive $10 as dividends. Okay? And then you still have the stock will be valued then, after paying out dividends, because retained earnings is the equity level at time one. Book value per share at time one will become what? Book value per share at time one will become what? Yeah, $100 again. It's just $100 again, right? So think about it. Is the dividend, if they didn't pay out dividends, right? If they didn't pay out dividend, you will get, if they didn't pay out dividend, if you sell the stock, you will get $110, right? You can recover $110 if you sell the stock. And then if they pay out dividend, so they paid out $10 as dividend, so you receive $10 in cash, right? Because it's dividend. And then you sell the stock, right? You get $100. So eventually, it's the same banana, isn't it right? Whether the company doesn't pay out dividend or not, right? If the company doesn't pay out dividend, you will still recover $110 by selling the stock. But if the company paid out dividend, you will get also $10 in dividend first, and then by selling the stock, you'll get $100. So still, you recover $110. Right? Does that make sense? So this is called dividend irrelevance theory. Dividend irrelevance theory. Right? Whether they pay dividend or not, right? It is irrelevant because from the shareholder's perspective, right? It's the same, same cash flow from the. But of course, because this is based on the book value, right? Although book value may be like this, but in the market there will be a movement in the stock price that will be different from the book value, so it won't be exactly the same. But the rationale is the same. Dividend irrelevance theory, right? Dividend irrelevance theory. The rationale. Another thing. So when they pay dividend, right? After paying dividend is called ex-dividend. Ex-dividend, right? And you know what that means? You know what ex-husband, ex-president, ex-wife means, right? That's past, right? So when they say ex-dividend, that's after paying dividends. So when they ex-dividend price, the price after paying dividend. An ex-dividend price would be always lower than pre-dividend, right? Makes sense? Because they have to. The profit has gone down because retained earnings is lower than pre-retained earnings, right? Pre-dividend. I'm sorry, pre-dividend, right? So that's what it means. Okay, so stock dividend is not a good thing. Merchandise, of course, it goes without saying. If you have stocks in General Electric or LG or Samsung, what if they pay, instead of paying cash dividends, what if they pay you dividend in TV or refrigerator? For every, let's say they pay you dividend in merchandise for every 500 shares. For every 500 shares they pay a TV, or TV is not that, but refrigerator. How would you pick it up? It's gonna be, right? That's a bad idea. Sometimes a company with a lot of unsold inventory would do this to unload their unsold inventory, right? And then from the shareholder's perspective, this is really, really a bad deal because they cannot even sell it and turn it into cash flow, right? Now, preferred stock, it's often considered quasi-debt. That means almost, right? Almost debt. Actually, it is halfway between debt and equity. Why? It pays fixed dividend. So in other words, preferred stock pays fixed dividend like coupon of the bond. So that means regardless of the profitability of the company, right? Dividend on the common stock theoretically is supposed to fluctuate with the profit level, but in preferred stock, it's a fixed payment, which is called a perpetuity. So preferred stock is also
called perpetuity. Perpetuity. What do I do? Perpetuity.
So perpetuity is basically, annuity going on forever. Literally, perpetuity, right? Bond is an annuity, isn't it right? Bond is an annuity because bond pays, regular coupon at regular interval, and it stops at some point. Perpetuity is something that goes on forever. There is no maturity. But preferred stock is unlike that in that it has no maturity date. Yeah, that's why it's called perpetuity, I said. Because they have a fixed claim on the firm's income that takes precedence over the claim of common stockholders, right? That means dividend on the preferred stock is paid before paying dividend on the common stock. That's the only thing that is preferred about it, right? Dividend on the preferred stock is paid before dividend on the common stock. That's the only thing. So that's why preferred stockholders are exposed to less risk. Yeah, that's true because you keep, risk is evaluated from at least 5 different aspects, not just this. Now, preferred stockholders are not normally given a voting right. I talked about this already. Although preferred stockholders are sometimes allowed to elect one member of the board of directors. Okay. Now, some institutional aspects. Now, these are all, restrictive covenants may include provisions about passing dividends, sale of senior securities, mergers, sales of assets, minimum liquidity requirements, and repurchase of common stock, blah, blah, blah. But basically, what if they pass the dividend? Right? Yeah, that can happen. Why isn't it working? Oops. The ink doesn't work. Okay, passing dividends. Now think about it. If you have no money, right, no profit, you cannot pay dividend. Although preferred stocks are supposed to pay fixed dividends, but if the company is in loss, they have no funds to pay dividends from. So sometimes they can pass it. But once they pass it, then think about it. If I'm a bondholder, company may skip paying coupon because if the company is not in good shape, they cannot pay coupon interest. Well, they can skip it, but this is already a serious issue. But once or twice, the creditors may allow that. But then, if the company is back in good financial shape, then whatever is passed up, the interest owed should be paid later. Isn't that right? Isn't that right? Of course. Think about it. If you cannot pay, suppose you have mortgage. You skip some mortgage payment because you lost your job. But of course, the bank will not be easy on you. But you can cut a deal. Oh, please, I cannot. But I will pay back everything, later. I'm gonna, I'm in transition. I'm between jobs, and I'm going through an interview, and most likely I'm gonna get this job. I will know in 2 weeks about that. So let's say you are back you're back in, no, you're back on your feet. Then the payments that you passed up, right? The payments you skipped, you will have to pay all of that later, isn't it right? If you skipped, 3 payments, you will have to make it up later. Just like that. Sometimes, companies may skip paying, dividends on the preferred stock, but then later, do they make it up? There are 2 things. Cumulative preferred stock means, yeah, you have to make it up, right? They make it up. It's called, arrears. Something is payment held in arrears. What does that mean? You haven't paid that, so you are behind in account, right? You're behind in account. That's in arrear. You are in arrears. The payments in arrears. You have payment. Arrear means in French behind. Arrière. So that means you're behind. So whatever is in arrears, they pay later. That's cumulative. It's called cumulative, right? All past dividends in arrears, along with the current dividend, must be paid, right? All past, along with current dividend, must be paid before paying dividend to common stock. Okay? This is the only thing that's preferred in the preferred stock. Before paying dividend to common stock, all the accumulated dividends must be paid. And there are non-cumulative preferred stocks. This is sometimes whatever is skipped, it's passed, right? It doesn't accumulate. So in this case, it's because dividend is optional, right? Because basically in stocks, dividend is optional. When you don't have profit, you don't have obligation to pay. So there are 2 types of preferred stocks when they have unpaid dividends. So callable feature, conversion feature, these are not something you can read up. We couldn't even talk about IPO. We should talk about IPO. But since this is all the time we have, we're going to be talking about IPO. We'll have to, won't take that much time. Next Monday, okay? Any questions? Any questions? All right, if you have no other questions, I will, I'll have to call it a day. I'll see you guys on Monday. All righty, you too. So I will see you guys then. I'll have to, so any questions there in the Collaborate? Any questions? No? Okay, I will see you. All right, I will see you guys on Monday, okay?